Welcome back. Well, let's focus on the retail participation. And the retail participation has been something that everyone's been appreciating. And personally as well, most of your money goes into SIPs, which we believe that over a longer span of time, well, it'll hold well. The only fear is retail getting into a bit of a trap? And that's the fear, but that's been the case as well. If you look at the SIP numbers, well, beautiful looking numbers. In the last 6-7 years or so, that retail number, the SIP number that you're seeing, has moved up from around 3,500 crores all the way to around 21,000 crores, which is very, very encouraging, up closer around 6 times odd in 7 years. As a proportion of the total free float, Motilal Oswal, they have put out this note, which they have titled the Retail Rhapsody. And they have highlighted that, as a proportion of the total free float of Indian market capitalization, the DIs and the retail, well, their holding has gone up substantially from around 55% all the way to around 63%. Not just their holding, but even their participation has gone up, quite a bit. So in the last 10 years or so, the non-institutional participation has gone up from around 38% to around 52% or thereabouts. Some on the street would say, well, that's a little bit scary. But those are the data points that's put out by Motilal Oswal. You have the FII flows, they've been quite volatile. And that's been the case. If you look at the monthly flows, the FII flows, well, they've been all over the place. But the encouraging part is the DII flows. And in the first half of this calendar year so far, you just take a look at it, well, the DII flows at the half-year mark are more than what we saw in the entire of last year. So the DII flows have been the key reason that have been driving this market higher. Since we have the retail support, the domestic flows as well, that's led to a relative outperformance. And that's why, the weightage on the MSCI index has moved up from the mid-single digits all the way to around 19%. Because when the markets move up, higher market capitalization, that's resulting in a higher weightage. The problem is, the question that people are putting out is, are retailers getting into a bit of a trap? At least as of now, that narrative that India's retailers, well, they buy at the top and they sell at the bottom, well, that's not yet happened. So as of now, it appears that that saying is actually reversed. And this time around, they could possibly get it right. The only problem is two factors. We've been talking about PEs and other data points. Just want to highlight India's market cap to GDP. As of now, it is at a relatively higher level if you compare with what we have seen on average of around 85%. So that's one data point. And the other one is the outperformance of the broader markets. Whether you look at the mid cap, you look at the small cap space, well, that's been where the big money is. And that's over a 5-year horizon that have put out these numbers. Well, in the shorter duration, that's in the last 1 year or so, well, it's been even more startling. So that's the big question. Retailers, well, they have been participating, appreciating that performance. But the problem is, are they getting themselves into a bit of a trap? Well, Gautam, let's come across to you and get your view on this. Everyone's appreciating this big retail boost. But in the past, we have seen that retailers, well, they buy at the top and then they sell at the bottom.